If your business faces a sudden cash crunch, whether it's to make payroll, restock inventory, or bridge a seasonal gap, a working capital loan sounds like the perfect lifeline. But here is the terrifying reality of 2026. Two lenders can offer you a loan for the exact same amount, use the exact same vocabulary, but one will charge you a fair rate while the other secretly charges you over 60% APR. Now, I'm not a CPA, so always be sure to check with one for any tax or financial advice. But today, we are unmasking the hidden math behind working capital loan rates so you can spot the trap before it drains your bank account. Let's look at the baseline data. Working capital rates are not a one size fits all. In fact, the spread is wider than it has ever been. At the top tier, you have SBA, working capital loans, capping out between 6 to 9% APR. Traditional bank and credit union lines sit comfortably between 8% and 25%. But the moment you move to online, short-term fintech loans jump to 15% to 45% APR. And at the absolute bottom, merchant cash advances, MCAs, can carry effective annualized rate of 40 to over 150%. Why is the gap so massive? Because traditional banks base their rates on prime rate plus a tiny risk margin, while alternative online lenders price their products based on speed, convenience, and how messy your recent financial data looks. Here is the biggest trap small business owners fall into when evaluating their working capital, confusing a factor rate with an interest rate. Alternative lenders love to use factor rates because they sound small. They'll say, we'll give you a $50,000 at a loan at a 1.3 factor rate. That's just a 30% flat fee. But here is the bookkeeping math they don't want you to do. Simple interest applies to a declining principal balance, so as you pay it off. A factor rate applies to the original principal for the entire life of the advance. If you take that $50,000 at a 1.3 factor rate, you owe $65,000 total. If the lender requires you to pay back through daily or weekly deductions over a brief 6-month term, your effective APR isn't 30%, it's over 60%. How do you avoid getting shoved into those high interest brackets? You have to understand how a lender's automated system calculates your rate. First is the base rate. Excuse me, this is their own cost of capital, usually anchored to the federal prime rate. You can't control that one. Second is the credit spread. This is the added on top based entirely on your own specific risk profile. Third are the origination fees, ranging from 0.5 to 5%, often hidden in the fine print. The lender's software scans your data to determine that credit spread. If you have low credit scores, less than 2 years in business, or choppy, erratic bank balances, that spread widens and your rate can skyrocket. The Bankable Books solution to forcing that rate down doesn't require a perfect personal credit score. It requires proving consistent cash flow. Because working capital loans are repaid quickly out of daily or weekly operations, underwriting algorithms care infinitely more about steady, predictable deposits than your long-term assets. If you let your bookkeeping fall behind, or if you deposit all your client checks in one erratic lump sum at the end of the month, the software assumes that you are a volatile risk. But if you keep your accounts reconciled daily, manage your accounts receivable tightly, and prove a steady daily cash position, you compress that credit spread and force the lender to drop your rate by 10 to 15 points. Working capital is a fantastic tool to help scale your business, but only if you aren't paying a premium for sloppy financial records. You have to know your APR, look past the factor rate illusions, and let your books do the negotiating for you. To ensure you are positioned for the lowest interest brackets before your next cash crunch, I am a certified QuickBooks ProAdvisor, and I can help get your books loan ready. Thanks for watching, and we'll see you in the next one.